Hello everyone and welcome to another Silicorp video here today, Wednesday, June 27th. I'm in the new apartment, so excuse the mess and possibly the noise. We're still getting everything put together. But I wanted to urgently make this video before it's already too late. In this case, talking about GameStop and what's happening with GameStop. To understand what's happening with GameStop, we have to understand the current market environment that we're in. And what does that environment look like? Well, about a year ago, retail trading made up about 5 to 10% of all activity on the stock exchanges. Today, from the reports I've read recently, that's north of 25%. Retailers, and when I say retailers, I mean individual investors like myself and possibly you watching this video, have become more active in the stock market. Now, why is that? 4 major factors. The first one being commission-free brokerages. This was pioneered by Robinhood a few years ago, and now has forced every brokerage, E-Trade, Schwab, TD Ameritrade, to offer free trading on stocks, and sometimes options, depends on the brokerage. So this wasn't possible, for example, in the 2000s, when it used to cost $30, $50, $100 to make a trade. Now it's free. The second thing is that what we're seeing, stimulus checks. Investors, people in general, now have money and they don't necessarily know what to do with it. The third thing is that gambling, sports betting, casinos was shut down for an extended period of time. So if you wanted to bet on something and you could no longer bet on sports because sports were canceled, you could no longer go to the casino because the casinos were closed. You were forced to stay in your homes. Well, you can turn to the stock market, the world's biggest casino, and participate that way. And lastly, the prominence of social media. This wasn't possible in 2000 as there was no Reddit and there was no Facebook and Twitter and so forth. But now with forums, like Reddit and so forth, it's much easier to congregate and share a message and plan. So I lay that out as because those are the 4 main ingredients to what now has become an absolute rocket ship of high short interest stocks, specifically GameStop. So GameStop was a $4.50 company about 6 months ago. It's now trading north of $300. What happened was the subreddit, Wall Street Bets, a lot of people on that site got together and started buying GameStop stock and also out of the money call options. In doing so, they raised the price of the stock, as now there's a huge demand and a huge amount of buyers entering the specific stock. Because of the high short interest, investors who were short, Wall Street who was short, were forced to cover or forced to hedge. So if they were writing these call options, or if they were physically short the stock, since the position of GameStop, since the stock price of GameStop was going to the moon, they were being forced to cover those shorts. They were being forced to buy the stock along with everyone else at market price. Again, now you're having even more demand. You're having even more buyers enter the market. Also, the writers of these call options had to hedge their positions. And since a call option is a right to buy 100 shares of a stock, if you are writing the option, you are selling the option, you're giving the counterparty the right to buy those 100 shares, you want to hedge your position. It's called delta hedging. And to do so, you want to buy stock, a covered call, for example. And so because of the movement we've seen in GameStop, because of the masses orchestrated on Wall Street Bets that got into this name, the money that was flowing into this name, and due to the elevated short interest, again, north of 90%, as of yesterday, I believe it was 141%. This caused a massive demand for GameStop stock, either by people buying it to prop it up further, or by shorts trying to hedge and or cover their positions. So that's essentially what's happening with GameStop. It's an essential massive short squeeze And again, a short squeeze being is that shorts are forced to cover their positions as they're being, as they're being margined out, as they're being stopped out of their positions. And when shorts leave, new shorts are now coming to, are now taking their place. It's like World War I, wave after wave now of shorts are kind of coming in, trying to guess the top. Because GameStop is not worth a $21 billion company. In fact, many people, including myself, have compared it to Tilray. For those of you who don't remember, Tilray is a cannabis stock that IPO'd around $17. Gradually, it made its way up to about $60, and then it started growing rapidly, 60, 70, 100, 150. And then one day it went from 150 to 300 by the afternoon, where it was halted, and when it opened back up, the stock plummeted back down to $100, and now it rests at $17 after a few stock splits. So that's what shorts are expecting to happen to GameStop. It's not worth $21 billion, and this craze of Redditors who are pumping up the name and now momentum traders and those trying to join the ride will eventually come to an end. Unfortunately, guessing that top has been pretty brutal for the shorts so far, as there's been billions of dollars in losses for these shorts. Citron Research closed their position. Melvin Capital, which was another one, closed their position, suffering over 100% losses. So the risk reward for this is just doesn't seem fantastic, and I don't know how you sleep at night if you're a short GameStop. But it's not just GameStop. We're seeing this now trickle down to other high short interest names: Fubo TV, Carvana, GSX. I think it's a Chinese company. Bed Bath & Beyond, BlackBerry. Recently today, one of my favorites, Build-A-Bear. All these high short interest names now are popping off as Redditors and others are anticipating what the next spike is going to be. What's the next fad? Included in that list today is also Nokia, which I don't believe has a high short interest, but the stock was $4.50 a few days ago. Again, a penny stock, and today it traded north of $7 and closed around $6.50. So when will this mania end? Who knows? Will Wall Street bets on Reddit be closed down? Probably, but who knows when? But the market today, the NASDAQ and the S&P were down over 2% today. And despite encouraging news from the Fed and despite upbeat earnings, I believe the reason why it's down today is that investors are looking at this market and saying valuations are already stretched. The word bubble was being thrown around a lot, but the amount of retail frenzy that's going on now is something to worry about, and it's something to be concerned about. And it's the most obvious example of market frothiness and bubble-like characteristics that there can get. So there's always one way to justify a valuation, either because of low interest rates and free capital and so forth. But when you see the frenzy that's going on in GameStop, when you see it's up 150% every single day, when you see what's happening in some of these other high short interest names, it's definitely a loud bell. It's definitely a big red flag out there that every investor who's managing other people's money is looking at and saying, well, now wait a second, let's reevaluate our situation. What's the new risk and reward framework look like? So again, this was a little bit longer video than I would have liked, approaching 9 minutes. I apologize for that, but again, that's just my 2 cents on what's happening with GameStop, right? The short squeeze that we're seeing, why it's happening, the 4 factors I laid out, stimulus checks, lockdown, commission-free brokeraging, and monetary and fiscal tailwinds as well. And then also the other implications. Again, other high short interest names now are popping off in anticipation of it being the next GameStop. So again, no recommendations or investment advice here at all, but just a little bit of knowledge here that hopefully you can use to prepare for your investments and take home with you and share it with the kids. All right, that's enough for me. Good night, guys and gals.